Hello, welcome back to Economics 352. I'm your professor, Todd Yarbrough, and welcome to week two. Week two is a very interesting week because we really, throughout the course of the week, will drill down to a fairly granular level of the macroeconomy in service to the idea of short-run stabilization. So the course is roughly split between several different timing considerations. Short run, then we'll sort of move into the median run, and then when we get to the end of the semester, we'll be looking at long run economics. And it ends up being the case, not so much that there are different philosophies as to what sort of range of time you're looking at, but rather that the things that we're concerned about within those particular timeframes ends up being a little bit different. So if we're looking at the economy over the very near term, the very short run, there are certain things that we end up caring about. And then as we elongate our consideration of the economy, we add in additional concerns. And to some extent, the importance of concerns starts to shift a little bit. And so this week we'll focus on short-run economic fluctuations, and a lot of the conversation will end up having to do with policy. What role does policy have in maintaining the economy over economic fluctuations, some of which are caused by so-called exogenous shocks, as we saw in the 1970s with oil price shocks, as we saw in 2020 with the COVID shock. So there are things that can happen to your economy that in a sense you had nothing to do with or had very little influence over. And we're interested in what should policymakers do or also not do as a result of those particular fluctuations. Now, let's take a step back for a moment and remind ourselves where we were and then kind of do a little bit of a setup for today. So far we have considered a closed economy model of the national income identity. That national income identity is Y, that is output, is equal to consumption plus investment plus government spending. Now again, because there's no net exports here, this is a closed economy. And in our simple closed economy model, we have a nice, efficient, if you will, identity, which says that the economy will come into equilibrium. So this will be true when this is true, basically, when savings is equal to investment. And furthermore, the real interest rate ends up being that equilibrating force. One of the things that economists do is we think about interest rates as being prices, generally speaking. And so just like prices are the equilibrating force in markets broadly, interest rates end up being the equilibrating force often in the markets where they're important. So the loanable funds market, interest rates are the equilibrating force. The money market, interest rates become the equilibrating force. And of course, there's a lot of interconnectivity along the way. So the important part of the national income consideration, other than the idea that savings is equal to investment, is really the nature of what happens to interest rates as things in the economy change. So for example, here we have for the idea that savings increases. So let's say for whatever reason, there's an exogenous increase in savings in your economy. It's important to understand that in the neoclassical income model, savings is not any sort of choice variable. We actually typically don't even make savings a function of anything other than just taxes and government spending and the overall level of consumption. The government spending and taxes themselves being treated as exogenous in the model. Consumption is endogenous, but a function of output and taxes. Again, those that end up being exogenously set inside of the model. And so in terms of what is affected by fluctuations in the interest rate, it ends up being this sort of investment mechanism. So for example, again, if we have a decrease in the level of savings in the economy for whatever reason, this is going to put downward pressure on the real interest rate. And as we have downward pressure on the real interest rate, we are going to move along the investment demand curve to a higher level of investment, as we would expect. And so an increase in savings triggers a decline in the real interest rate, which ends up putting us at a higher level of investment. Now, importantly, we would add on to this analysis the idea of it being a ceteris paribus effect. In other words, if in our closed economy model there is an exogenous increase in the level of savings, then ceteris paribus, all else equal, holding all other factors in the macroeconomy constant, we expect a lower real interest rate and a higher level of investment. One of the more important kind of ideas that we don't end up getting to develop too much in intermediate macro, but you end up developing later on, especially in the graduate level of economics, is the idea of transmission mechanisms, right? So you have variables change. Those variables trigger often behavioral changes in individuals, and then kind of downstream of those behavioral changes, we get the macroeconomic changes. So, for example, if there is downward pressure on real interest rates, the downstream effect of that is going to be a higher level of investment. So we can say an increase in savings triggers a reduction in the real interest rate. That reduction in the real interest rate then triggers a higher level of investment, all else equal, holding all other things constant. Now, one of the questions that students are often interested in is, what happens when you open the economy up? What sort of necessarily changes? Now, we're going to kind of set up the open economy mainly in service to something we're going to do a little bit later. So it's sort of a setup to something we're going to do in a few days. But we're going to open the economy up because we want to make sure that we introduce the idea of trade flows, and also that we introduce the idea of the exchange rate. It ends up being a really important feature of a model we're going to learn later on called the Mundell-Fleming model. The exchange rate ends up acting like the equilibrating force we see with interest rate in this particular model, or prices in a general market model, that the exchange rate ends up being that equilibrating force in an open economy model. Okay, so let's talk a little bit about sort of what it is that we do in the context of the open economy model before we get into the sort of theoretical and conceptual ideas. The first and foremost idea is that in the open economy model, we do not necessarily need savings to equal investment. And in particular, we do not necessarily need domestic savings to equal domestic investment. In other words, in the open economy model, domestic savings can be greater than domestic investment, or vice versa. In particular, when we say domestic investment, we mean the amount of investment that is going on amongst investors in that particular country. The key idea here is that if I'm an investor, I can invest domestically, or I can invest internationally. And so in this scenario, the total level of savings ends up still equaling the total level of investment. It just ends up being the case that investment is now broken up across two different types. There's domestic investment, international investment. And what we get from this is the notion that net exports are equal to savings in your economy minus investment. What that means is the extent to which you are exporting relative to importation, right? Because net exports are exports minus imports. So the extent to which exports are greater than imports is going to be equal to the extent that savings is greater than investment. Or, to think about it another way, the extent to which that imports are greater than exports will be equal to the extent to which that investment, the overall level of investment, broken up across both domestic and foreign investment, is greater than savings. Okay, so the key idea of savings equal investment falls away, but what we get in it is another sort of simple identity, which says that the level of net exports in your economy are going to be equal to what you save minus what you domestically invest, okay? So we're just gonna add a D here just so we can sort of establish that we're talking about domestic investment. Now, we'll also add a D here as well, it's domestic savings. The idea here is that instead of the real interest rate always keeping domestic savings equal to domestic investment, that will no longer necessarily be the case. Now, what is different in this particular model that makes that perhaps not necessarily be the case? Well, what ends up being different in this model is the introduction of what we're labeling R star. R star is the international real interest rate. So the idea is that there are two interest rates. There's a domestic real interest rate R, and there is an international interest rate R star. Now, we start out with the conception of the model that R is equal to R star. You get sort of a perfectly competitive kind of idea here that in a small closed economy model, the small economy doesn't affect other economies. So my interest rate doesn't affect other people's interest rates. This will be something that we change a little bit when we consider large economy models. But regardless, the idea here is that we start out with the assumption that domestic interest rates are exactly equal to the international interest rate. Basically, that investors end up being indifferent between those two types of investment. They don't favor domestic investment over international investment because the cost of doing that investment is equal. The cost of that investment is the real interest rate. In that particular world, we can have the scenario in which the level of domestic savings is greater than the level of domestic investment or less than. Now, we can talk about some general trends that we might expect in this particular model. So for example, let's say the domestic interest rate is greater than the international interest rate, right? So again, we can think about interest rates as being the cost of investment. So if my domestic interest rate is greater than the international interest rate, that means investing at home is more expensive than investing abroad. So in other words, if the global interest rate is less than the home interest rate, I expect investors in the US to perhaps shift their investment overseas, right, for example. And so the result of a interest rate domestically, which is greater than the international rate, is that you have what's called net capital inflows. So net exports, in fact, decrease, right? And the reason why you have net exports decrease in this scenario is because now it becomes more profitable to invest internationally, and because you get more capital inflow. In other words, you have companies and firms in the domestic economy borrowing money out of foreign economies to invest in foreign economies, then we have this net capital inflow. So you have foreign capital flowing into the domestic economy. As foreign capital flows into the domestic economy, this puts downward pressure on net exports, right? And if we have the domestic interest rate is less than the international interest rate, then as you might expect, we have the opposite, right? We have net capital outflows. Now you have domestic money, which is being invested overseas, and in that you have exports rise against imports. And so the key idea here is that while we will generally start off with the assumption that we have this equilibrium between R and R star, what I think ends up being perhaps the most interesting part of the story is what happens when you have divergences in real interest rates across the domestic interest rate and the international interest rate. And the reason why I think this is perhaps so important is because it actually takes us back to the relationship between savings and investment in the economy. So despite the fact that we open the economy up, and despite the fact that we say that no longer do domestic savings equal domestic investment, we still see that that idea of domestic savings equaling domestic investment is super important. I also think this is important because it plays a large role in our conversations about trade deficits writ large. And so, for example, in the US, we tend to have higher interest rates than what you can get overseas. So the US real interest rate tends to be greater than the other global rates. This helps to explain at least partially why the US is a net importer of goods. Because we have a higher interest rate, this means that domestic investment suffers to some extent versus international investment, as we've seen. And then, of course, the other piece of this as well is that relates back to the fact that in the US, right, the US tends to save less money than the rest of the world, right? And so the fact that the US saves less money than the rest of the world, which I think I've mentioned already this semester, that is one of the reasons why we have upward pressure being put on the US real interest rate. And that further exacerbates the fact that exports are falling relative to imports. We have a reduction in net exports as we would expect. And so if we're interested in, for example, reducing the trade deficit, if that is a policy preference or a policy interest, then the way that we can do that, according to this simple open economy model, is we get the economy to save more domestically. Because if we save more domestically, then that's going to put downward pressure on real interest rates. That puts downward pressure on the domestic real interest rate against the global interest rate, and that would reduce any sort of trade deficit that might occur. Now, it's important to understand that the trade deficit ends up perhaps not being necessarily a huge concern amongst economists. It ends up usually being more of a political idea, perhaps, than an economic one. At the same time, if we are going to entertain the argument of how might we reduce a trade deficit, the sort of granular kind of inner workings of a model would argue that you want your economy to save more money. And as we all know, the US economy has very, very low savings. And so it really fits nicely. The sort of conclusions of the model fit really nicely with what we see, even when we consider that the way this is end up setting up is that we start again with a small open economy model. And then as we work through, we start to ask ourselves, well, okay, what happens if perhaps it's not a small open economy, but instead of perhaps a large open economy? And that changes some of the dynamics. But at the end of the day, you'll see a nice consistency with the logic here. And the key idea for you to keep in mind as you're working through the open economy model is that it really goes back to these equilibrating forces. In a closed economy model, the domestic interest rate is the only interest rate, and so it's what keeps the economy in equilibrium. In an open economy model, we have a domestic interest rate and an international interest rate, and what we will find out later on ends up being the key equilibrating force ends up being the exchange rate, the extent to which currencies are traded amongst countries in terms of relative value. And what we'll find out is from this perspective here, we have a clear relationship. In fact, we're going to end up saying that net exports are a function of the exchange rate. And in particular, what we can say is that the relationship between net exports and the exchange rate is negative. That as exchange rates decline, net exports increase, right? And we'll see this in a very simple graphical representation where we have net exports here, we have exchange rates there, and then we have this nice downward sloping line where net exports are a negative function of the exchange rate. Hope you enjoy.